I'm Abdu-Raof, and this is the SA Diplomat Abroad. For the past 2 years, we've seen turmoil the world over with the dreaded coronavirus, which has ravaged our population, threatened our existence, and placed many of us in financial difficulty. Not even South Africa, with its far south location, was spared. The question we ask today is, are we reaching the end of this crisis, and if so, where to from here? We chat to Abdulazeez Davids of Kagiso Asset Management, who will give us a forecast of what 2022 will look like from an economic and market perspective. This is the SA Diplomat Abroad. Please don't forget to like this video, subscribe to our channel, and pound that notification bell. Also listen to us on Safa On Air World Radio through the Safa app on Play Store, the Apple Store, and Huawei App Store. This is the only radio station outside of South Africa that services the South African global community. Please also visit our website on www.sa-diplomat.com for all the latest information and news from this global South African community. We now get into the 2022 SA Economic and Market Outlook with Abdulazeez Davids of Kagiso Asset Management.
Welcome once again to the SA Diplomat Abroad. I'm Abdu-Raof, and once again we have in the hot seat Abdulazeez Davids of Kagiso Asset Management to unpack what 2022 looks like economically and from a market perspective. Assalamu alaikum to you, Abdulazeez, in Cape Town.
Wa alaikum salam, and thank you very much for the opportunity to once again talk to you, Mr. Henslow.
You know, it's always a pleasure having you on our channel because you bring a tremendous amount of intellect to the channel, and it increases our viewership on this side as well. Abdulazeez, the last 2 years have seen a tremendous amount of pressure on economies around the world, and not leaving South Africa behind. South Africa too has seen a tremendous amount of challenges and pressures over the last 2 years. Currently now we've seen the likes of geopolitical events happening around the world due to the pandemic and the lockdown procedures of various countries. And we've seen South Africa try to manage this on a scale where that same type of unrest or backlash doesn't happen in South Africa. But from an economic perspective, we've also seen communities around the world suffer over the last 2 years. And not taking anything away from South Africa, South Africans too have been suffering for the last 2 years. Abdulazeez, 2022 comes with a new added hope. We hear the news, we hear people saying, we hear the commentators all screaming that the pandemic is finally at a point where it's manageable, and very possibly we might see the end of the COVID-19 pandemic in 2022. That's good news, but it doesn't leave anything more in our pockets at the moment, financially. But from your perspective and from the South African market side, what does the South African markets look like currently since the last time we spoke?
Yes, thank you for that context. And I think it's important to always start with the bigger picture, and then we can always narrow it down in terms of looking at the South African dynamic. I think the bigger picture globally is that over the last 2 years, as you rightly mentioned, we have seen, the stop-start economy where many countries have gone into severe lockdowns and, various phases of lockdowns in terms of its severity. But by all accounts, that stop-start nature of the economy has meant that governments needed to respond in terms of the economic impact and to almost limit the economic fallout that would have ensued from those lockdowns. So I think the last 2 years, if you had to summarize it into 3 words, it's lockdown, it's stimulus, it's lower interest rates. And those 3 things have counteracted. Clearly, lockdowns, very negative for the economy, very negative for consumers, very negative for our ability to earn and have a living. So counteracting that and counterbalancing that was stimulus and was lower interest rates. By all accounts, and normally the economy works well ahead of the general society and expectations. So already we've seen the inflection point in terms of stimulus. We've seen the inflection point in terms of interest rates. Interest rates are starting to go up. Stimulus is starting to be withdrawn from markets. And by all accounts, you're absolutely right. We think that we're now at the end phase of the pandemic, and we're probably now going more into an endemic stage. I'm not a scientist or a doctor, but I believe what that terminology means is that we all will live with COVID, and effectively COVID will become like a seasonal flu, and no more severe. We won't see the significant hospitalizations and severe deaths that we saw in waves 1 and 2 globally. What that also means is that I think by all accounts, and again, I'm not a scientist or a doctor, but by all accounts, natural immunity coupled with vaccines has really taken the sting out of the COVID pandemic. And as a result, I think the world over, scientists and doctors are quite confident and optimistic that we're nearing the end of the pandemic. So I think that is by far the most significant piece of positive news. And that will be significant in terms of consumer behavior and positive sentiment. Counterbalancing that is clearly the fact that, as I've said, to varying degrees, we've seen countries and governments respond to the economic challenges by administering stimulus. In a South African context, we've seen roughly about 750 billion rand of stimulus being administered to our economy. In the context of global stimulus, the US, at last count, the total stimulus package, including the infrastructure spending plan, totaled just under $3.5 trillion. So much bigger numbers than we're capable of. But clearly that still, a lot of that still has to feed through the economic system, especially in terms of that $1.6 trillion infrastructure spending plan, which President Biden wants to push through. Similarly, places like China and Europe have had similar stimulus measures as well. Now, how does that affect South Africa? And more importantly, how does that affect our viewers and the listeners to the show? What is quite evident, and we've seen it in pricing of goods and services, is that inflation has really picked up quite significantly. The average basket of fresh fruit and groceries in South Africa is up anywhere between 15 and 25% over the last 2 to 3 months. On top of that, we've seen rampant fuel price increases and the back of sky-high oil prices. Oil prices back above $90 per barrel, as you know, being situated in the OPEC exporting country. And similarly, the currency at 15 Rand, say roughly 15 and 50 to the dollar, means that actually in Rand terms, our oil prices are very, very high. And that transfer mechanism is that we are all paying a lot more at the pump, and that feed-through mechanism to inflation as well. So I think the key challenge for consumers, for South Africans in general, is how do we cope with rising inflation and potentially spiraling inflation because of the second round and third round effects. As, for example, producers experience high inflation, they start pushing up their prices. That has knock-on effects on the broader economy. And as we know, wages do not grow at the same pace, typically, as the general inflation basket. Secondly, I think what is important is that our objective and our reason for being is always to try and protect consumers and investors' wealth. And by far the biggest threat to wealth creation is inflation, because inflation is like that stealth enemy that comes in the middle of the night and basically just erodes our purchasing power. And we need to be able to grow our wealth in nominal terms to just counteract, the rising cost of living, the rising cost of goods and services as well. So hopefully we'll share some information regarding that. But to just get to a broad scene, I think the twin threats currently for the global economy and for South Africa as well is, how do we cope with, already our interest rates have started to go up by 25 basis points. How do South Africans and the economy handle a rising interest rate environment? And arguably, withdrawal of stimulus to a larger degree that we've seen in developed markets, where the US is our biggest trading partner. They are going through the same adjustment period now. And then secondly, how do we cope with rising inflation, and what can we do to protect our wealth against the ravages of inflation as well?
Now, Abdulazeez, the last time we spoke, we touched briefly on interest rates, on inflation, and from an outsider, basically not an outsider, a South African living abroad. Whenever we come home, and the last time I was back in South Africa was in November last year, October last year at least, and I could clearly see, being away for 1 year, I could clearly see the difference in pricing in South Africa of consumer goods on the shelves when going to go do your shopping, or even just filling up at the tank, at the petrol station. I could clearly see there was a major difference. Previous year, it took me 1,000 Rand to fill up my tank of petrol. When I came back last year, that same tank of petrol in the same car costed me 1,300 Rand. To fill up. So clearly there was a 30% increase that I was even unaware of over the last year. South Africa is not a country that, like the United States, that has access to the huge amounts of capital that can be thrown into the economy for stimulus purposes. How does South Africa, going forward, intend to manage the debt, number one, that was incurred during the pandemic, and number two, to stimulate the economy to provide additional jobs for the communities and to stimulate consumer spending in general in South Africa?
Yes. Luckily, I'm not the finance minister, because those are the questions the finance minister has to grapple with. And, South Africa is a big ship. Our GDP is substantial in the context of Africa. So to move such a big ship can be quite difficult as well. And also bearing in mind, you've got almost, various counterbalancing forces, political parties with varying agendas and objectives that you need to all get to toe the line as well. So, answering that question, fundamental is, at the core of it is, we need to try and improve the quality of life for all South Africans. And I might sound like a politician, but it's effectively what the objective is and what should drive government agenda. And unfortunately, South Africa is unique in a global context in that our skewness in terms of inequality is one of the highest in the world. Economists talk about what they call a Gini coefficient, and I think if you put all the countries on one scale, South Africa is number 5 or 6, so in terms of the highest level of inequality. And unfortunately, the countries that precede us or are ahead of us are typically countries where you've got dictators and people that have amassed a lot of the country's wealth and basically plundered the wealth, and hence those Gini coefficients are skewed as well. So I think that is by far the most important challenge that we face. It's by far the most clear and transparent manifestation of all of the problems that beset South Africa. And if anything, if we can address that, we would be in a far better place economically, socially, and even environmentally as well. And I think the way to achieve it, and answering your question, how do we grow the economy? How do we rein in inflation that, as you experience, 30% in terms of fuel prices, for example? Clearly, it needs to come down to government action and government policy. And fundamentally, in investment markets, what we do is we allocate capital. We allocate capital by looking at companies, and likewise, there are similar people sitting in London, sitting in New York. There are also global capital allocators, and capital goes to the area which gives it the highest return. So we need to create an environment where capital finds a home in South Africa, capital is attracted to South Africa. I think that the one silver lining is that South African companies and even global companies are actually quite cash flush. There's a lot of cash out there. There's a lot of capital out there. It needs to be harnessed and redirected into South Africa to enable us to have these major capital projects that will foster job creation And through that economic engine that you then basically bring alive will actually result in much higher living standards, which effectively reduces the impact of inflation. So in summary and in a nutshell, effectively, we need to create an enabling environment where companies feel comfortable to allocate capital to South Africa, either domestic companies not taking their money offshore and invest globally, or foreign companies coming to invest in South Africa as well. And we do it in three ways. Firstly, we need to create an environment where economic policy is investor friendly. We can't have economic policies which chases away investors or scare off investors, be it through inflexible labor laws, be it through the ease of doing business, or be it through sheer corruption. Unfortunately, our dirty little secret as a country is the level of corruption, and that's something that needs to be urgently addressed. And we've got the Zondo Commission and all of that. Clearly, just on that topic, I mean, we need to see serious and significant arrests flowing from the Zondo Commission and its report to lend some credibility not only to the process, but to our government's willingness to address corruption head on. But that also feeds into attracting capital by addressing corruption. The second aspect is in terms of job creation. I think, as I've said, our labor laws are very inflexible. It's very difficult to employ people. And it's even more difficult to redeploy people as well. And I think that's an area that we need to address quite seriously. I read yesterday the one smartphone factory that opened in 2019 in South Africa with a lot of fanfares that actually closed after 1.6 billion rand investment. So clearly, with the and Asia in terms of access and level of jobs as well. And so we need to think globally. We can't just think locally in terms of the best sort of wages and employment numbers as well. Clearly, it's a very difficult thing, but I think we need to strike the balance in terms of our record unemployment numbers, which is above 50%, and versus flexible wage sort of environments and agreements that at least put money on the table for consumers. That when you're unemployed, there's no income at all. So I think that's just broadly some of the ideas and some of the proposals that need to be considered. And hopefully the president in the SONA address tomorrow, or hopefully by the time our viewers get to see this, the SONA would have taken place. But hopefully SONA addresses a lot of these issues as well.
Now, Abdulazeez, yes, this episode will be out on Friday, the 11th of February, obviously day after SONA. But I think one of the major events that has me sitting on the edge of my seat is the Minister of Finance's address later this month, because last year we spoke, and when we spoke last, we spoke about the debt level of South Africa due to the pandemic and the massive loans that were taken out in order to stimulate the economy of South Africa. Not only stimulate the economy, but to look after the people of South Africa. That has to be paid back. And the last time we spoke, we mentioned that it's interesting to see what the tax outcome would be, whether taxes will be raised, increased in order to cover the debt that has been taken out. So in your perspective, Abdulazeez, and I won't hold you to it because we're still waiting on the Minister of Finance.
Yes.
But that debt is not being spoken of much. I think the one major value was 500 billion rand that was pushed into the country to look after the communities that were suffering.
Yeah.
That 500 billion has to be paid back. And that has to come from somewhere. And the economy is not at a point where I think that they can afford to allocate sections of the budget towards that. So it has to come from somewhere. In your opinion, Abdulazeez, where do you think the minister is going to find the money to pay that back, the 500 billion?
Look, the one aspect that you haven't mentioned is just increasing borrowings. So if you look at how it has been financed thus far, it has been to increase the debt to GDP ratio. So we've actually borrowed more to finance the 500 billion that you've mentioned. And I think what we have seen, and one of the slides that we show, is just our trade surplus. Clearly in terms of again, we've been quite fortunate as a country in that we are metals or precious metals exporting country. We've seen precious metal prices rising quite significantly, so the likes of palladium and rhodium in particular. And that has given government quite a substantial windfall. Coupled with the weaker currency, we've seen the highest level of trade surpluses. The chart goes back to 1997, for example. So over 24 years, our current sort of monthly surplus, it's the highest it's ever been. And that means that we've got a positive balance of payments because our exports, the value of our exports is much greater than the value of our imports. And that is a source of funding for government. Your balance of payments is a source of funding for government. And that also has meant that the government last year could extend the TERS sort of relief scheme for the most indigent in society as well. Now, the billion or the 4 trillion rand question in terms of our GDP is how do we make it sustainable and how do we get sustainable levels of income? As you can see from that trade surplus chart, it's quite volatile in that for extended periods of time, we actually run trade deficits. Our exports are substantially below our imports. We import more than we export historically. So you can't rely on that as a source of funding or a source of income for you on a sustainable basis. Metal prices won't stay elevated for long. The rand might strengthen or imports might start to take off as the economy recovers. So I think you're absolutely right. There needs to be a rethink in terms of how do we allocate the budget. In particular, what I would like to see is that some portion of the budget is allocated for sustainable job creation initiatives. In particular, I mean, if you look at, for example, one of the big areas of spending is the expanded public works program. Now, that's a great program in that it takes people from communities. It gives them a stipend, I think about 2,000 rand a month. And they are then responsible for looking after their communities, keeping the streets clean, keeping recreational parks, etc., clean as well. So there's a sense of responsibility. The problem is that those projects are hand-to-mouth type projects. They basically cover short-term income needs. They do not address long-term economic growth. And what you would want from spending like that is typically a multiplier effect on your economy in terms of future GDP creation as well. Now, to do that, we need to reallocate. I'm not saying take that away. I'm saying add to that by having some portion of the budget allocated to proper infrastructure spending. Where there's electricity required, obviously we've got our challenges with Eskom as well. But where there's bulk infrastructure required to enable big business to be attracted to a particular area, provide those sort of infrastructure frameworks as well. And I think what you'll find is that 9 times out of 10, those infrastructure spending sort of plans from a government point of view actually has a multiplier impact in terms of future GDP growth as well.
Now, Abdulazeez, as far as the currency is concerned, the rand has been on a roller coaster for the last 2 years, but it's also reached close to its all-time low in the last year. Where we find ourselves today, it's nowhere close to recovered to a place where we can say it's safe. The rand is still weak.
Yes.
In your perspective, what's the future of the rand for 2022?
Sure, there's so many factors that influences the rand. I'm bound to be wrong. So if we look back at this in a year's time, you'll basically say I was wrong. I think what is important to recognize is that there's a myriad of factors that influences currencies. In particular, the single biggest driver of our currency is the value and status of the US dollar. So if one looks at most currencies are obviously denoted or expressed as relative to the US dollar. The US dollar, has gone through periods of extended weakness. But likewise, effectively in a rising rates environment, the US dollar should actually strengthen. So if the dollar strengthens, it means all currencies, and especially emerging market currencies, currency should weaken relative to the dollar. So that's by far probably the single biggest driver of the currency, is that we are now in the realm of rising rates in the US, which should theoretically result in a strengthening dollar because capital goes back into the US and is attracted by the high interest rates, resulting in a weaker rand. Having said that, again, we're coming back to the adage that, it comes down to purchasing power parity. Our inflation is higher than the US inflation at the moment, but also importantly, we're in a lower economic growth scenario than the US. So our ability to attract capital is also compromised as well. So we would think that there would probably be a slight weakening bias towards the currency. But again, it depends on your starting point. Anywhere between 14 Rand 50 to 15 Rand is probably a normalized level for the current, reflective of the current economic challenges and realities of South Africa as well. So I would say, where the currency is currently, it's probably a fair value, even though it is relatively weak. For us to see meaningful strengthening in the currency to say below 13 Rand or 13 Rand 50, we need to see substantially better outcomes in terms of economic growth. We probably will see, or we probably need to see substantial increases in rates in South Africa as well, to attract that capital to allow our currency to strengthen significantly from current levels.
So I think it's all related to what you said previously, as far as stimulating certain sectors of the workforce and business, because I guess the more export is stimulated from South Africa outwards, the more the stronger our rand would also eventually see on the shores of South Africa. So in 2022, I mean, we've seen a lot of businesses close down. We've seen a lot of pressure on businesses. We've seen a lot of businesses cut down on workforces and even on sizes of businesses. In the stimulation of the economy after the pandemic, post the pandemic, let's say the pandemic ends tomorrow, should the focus of the government first be, and the private sector, to stimulate those businesses that specifically look at export for the general global market than anything else in order to stimulate the economy?
Yes, I fully agree with that. I think if one looks at the framework and a checklist of what are the priorities and what are what I would call the easy wins and the low-hanging fruit, you need to work with what you got. Okay, that sounds very corny, but effectively, what do we have in our favor that we can use and to attract foreign capital? And by far, you're absolutely right. I mean, obviously, exports is a key area. And try and, I mean, a crying shame for South Africa is that we've got massive rail challenges. So Transnet and its inability to fully benefit from these high commodity prices by exporting as much minerals as we can. And that's just a sad reality. If we can fix our rail network where Transnet can increase from our iron ore to our manganese to our our precious metal exports to benefit from these high prices, I mean, definitely there'll be a lot of foreign exchange coming into the country. But I think more important than that, something that doesn't require capital is actually our tourism sector. We've got natural sort of attractive geography. We've got Cape Town, we've got Durban, we've got various places across South Africa that naturally should be attractive for tourists coming into the country. So we need those to be reopened and to allow foreigners to come back into those sectors, because those are typical sectors where you see high employment levels and very low capital requirements, which is the best sort of economic areas, because what you want to see is bang for buck. You want to see foreign currency coming into the country, jobs being created without necessarily putting strain on government finances because of capex spend or infrastructure spend. So I think the tourism sector and the leisure sector has been hard hit by the pandemic. So if the pandemic, to your question, ends tomorrow, I think we need to almost have a tourism indaba where we seriously address the tourism sector and allow those markets to open much more aggressively than the rest of the economy as well.
Now, Abdulazeez, as far as the interest rates are concerned in South Africa and inflation, we've seen the massive inflation over the last 2 years. And from a personal perspective, I don't see that ending very quickly as far as the increase of consumer goods are concerned and the cost of living is concerned. But as far as interest rates is concerned, what's on the cards for interest rates? I mean, the one thing that I always look back on is the fact that once interest rates increases, that curbs a little bit of debt, consumer debt. But when interest rates come down, it's the adverse effect. It stimulates debt.
Yeah.
In 2022, what can we expect from interest rates in South Africa? Because obviously, if one looks at your debt slide alone, as far as the significant increases in debt, the emerging economies are sitting above where we were in World War II.
Yes.
So that's concerning.
Yes.
So obviously that has to be curbed somehow. And do you think there should be a concerted effort made to increase interest rates to curb debt at this present time?
Yeah, so that's a good question. And just talking about that slide, I think what is important to note is that we've got the advanced economies and emerging economies, and that slide goes back to 1880, so before you and I were born. But what is significant there is that the debt levels, especially for advanced economies, are at similar levels to what they were at the end of World War II. Basically approaching 120%, that's debt to GDP. So 120% debt to GDP. Emerging economies are sitting roughly at about 60-65% debt to GDP. Right? The challenge with debt, and that's why we run Sharia funds that don't have debt and don't have riba in it, because the challenge with debt is that, especially for the borrower or the person that is in need of the debt or is indebted, they don't really have a say. When rates move, you have to pay more. So it's what they call a grudge payment. You effectively do not have any control over it. Now, if one extrapolate that to the South African government or even the US government, the US government is sitting with a stock of debt, if you look at just the Federal Reserve, of about $8 trillion. Now, interest rates are close to record low levels. In fact, the US 30-year rate went down to 1.7%. That rate is already up by 0.5% to 2.2%, which means that for every 10 basis points, the US government is paying $800 billion more in terms of interest costs. Now, the catch-22 with rising rates is that on your existing stock of debt, you're paying a lot more because the rates move, and it's obviously floating rate in terms of its impact. So whilst you are right in terms of saying that rising rates will curb further indebtedness, the pain that it causes in terms of you forcing to be paying more for your current stock of debt is obviously quite significant as well. So I think in terms of a rates outlook for South Africa, I think we probably will see at least another 0.5% increase in rates, probably in the next couple of meetings. But from there, it will be a function of what inflation is looking like. Hopefully, they would look at the impact on economic growth. But bearing in mind, I mean, we're coming from a fairly low level, 3.5% in terms of the base rate. So, another, let's call it 0.75 or 1% increase. It's about a 30% increase in the movement or the delta, as I say. Now, if you were paying 10,000 Rand on your on maybe interest on a loan, a 30% move effectively implies, your interest payments going from 10,000 to 30,000, almost similar to your fuel going from 1,000 Rand to 1,300 Rand. Now, that is significant, and I think few consumers can actually afford to see that level of interest cost increases in terms of their monthly repayments. So that's why I say it is going to be a fine balancing act. It's a catch-22, in terms of saying we need to rein in inflation by raising rates. On the other hand, the economic impact of rising rates can be devastating, especially for people and companies and governments that are more indebted now than what they were, say, 2 or 3 years ago as well.
Abdulazeez, coming back to the COVID pandemic, when one looks at the markets prior to the pandemic, there was obviously risks that affected the markets. One never expected anything like a global pandemic affecting the markets the way it did over the last 2 years. And I mean, the one specific factor that always affects the markets that we know of is the geopolitical events that affects the markets directly. But now it's from a medical perspective.
Yes.
And looking at your slide, when looking at the COVID-19 risk tolerance, which remains very low in Asia, it tells us a different story of how we look at the pandemic. Because from South Africa's perspective, the furthest southern country in Africa, very far away from Asia, but Asia obviously has a different perspective on how they've managed the COVID-19 pandemic.
Yes, I think that's by far a very good observation, and I think one of the biggest untalked about risks, I think, for the global economy. And why do I say that? If you look at South Africa, we were in a hard lockdown and various stages of lockdown over the last 2 years. But I think, by all accounts, very few South Africans many South Africans did not adhere to the lockdown measures. So notwithstanding lockdowns, we've actually seen rapid increases in terms of infection rates, which has been quite negative. I think there's a whole body of research that suggests that our fatalities have been a lot higher than actual official reported numbers. But if I can call it that, the silver lining is that we've actually built up significant natural immunity as a result of that. So I think the Government Advisory Council estimate that we've got 80 to 90% natural immunity from people that have actually got the disease and survived it. And coupled with about a 30% vaccination rate, it means that South Africans are, we've gone through the worst potentially. And that's why I think if one compares the Omicron variant in terms of its severity and its impact on hospitalization and deaths in South Africa, it was actually quite benign. It was quite low versus some other countries. So in hindsight, I think lockdowns there might be a question mark in terms of lockdowns and its effectiveness. Look, the rationale for lockdowns has always been to preserve hospital capacity, which we saw in wave 1 and wave 2 in South Africa was under severe threat and strain as well. So in the Asian, I think China has this zero COVID policy, where any sort of hint of an infection is met with the full brunt of government locking down areas, locking down cities. And one can see it currently in the Winter Olympics as well, the extreme measures that they're taking in combating any infections. I think that is to the detriment of the economy. And by all accounts, if the whole world have to go from a pandemic phase to an endemic phase, we need to drag China along with us. And the reality is we're living in a global village. We can't have one area of the world with no natural immunity, with no herd immunity, and then unlocking and basically going away with their lockdowns and expecting there not to be a rise in cases. So I think that's by far the biggest challenge for the whole Asian region. Many of those countries from Singapore to New Zealand, China, they've all had very strict lockdowns to try and minimize and reduce infection rates, which I think in hindsight might be too detrimental to the economies and might actually slow down their ability in future to recover from the pandemic relative to the rest of the world as well.
Now, Abdulazeez, where I live in Doha at the moment, I mean, we have a 95% vaccination rate here. Yeah. But here also, like Asia, they've been very intolerant from the government perspective towards the communities. And I say this with utmost respect. They've basically instituted laws to protect one from yourself, to put it that way. Here areas were locked down. We were under strict lockdown where we could only have 2 people in a car at a time, others you'd be jailed. Found outside without a mask, 5,000 real fine on the spot, and those types of things. But ultimately, it has worked. The Omicron variant has affected Doha, Qatar, but we've seen no mortalities, and we've also seen a very good recovery, a short period of recovery for anyone affected by COVID-19. But, you know, each and every country has their own market. And when looking at the South African market, though we were pressured by the economic restraints of the last 2 years, we still see equities that have rallied during this period. And I mean, to the extent now, I mean, if we look at the markets on a wider perspective, in your slide dating back to 1945 to the current date, then it really shows that the market trajectory over that period really hasn't changed.
Yes.
It's been an upward trend, and it's still on an upward trend.
Yes. And
give us the synopsis of exactly what's happening in equities at the moment.
Yeah. I think that's by far the most significant bit of good news for our viewers and those following this program, is the fact that over long periods of time, equities have been the right place to be. Notwithstanding, I mean, issues like, depressions and recessions and economic sort of, misfortune that has befallen markets, the market or equities have the self-correcting mechanism, which means that they will correct and will recover from any losses. And this is proven through vast amounts of data and time series of actual market returns. What is clearly quite important is that, these periods of volatility and market underperformance gives our investors and our viewers the opportunity to actually get into the market. So March 2020, for example, when our equity market declined by 35%, that was almost a once-in-a-lifetime opportunity to get equity exposure, because the subsequent recovery and rebound that we've seen has been very strong in terms of our equity market. Many investors in our funds, for example, that invested in March 2020 have doubled their money in the space of about 2 years. And they're all smiling, they're quite happy with what they've done. So I think, equities, whilst we might talk about challenges and it might come across as quite gloomy, COVID, pandemics, all of these things, I think the good news for viewers and listeners is that equities over the long term is still a very good place to be. Even with rising rates, what we will see is that a rising interest rate environment means that the cost of capital needs to also rise, which means companies, to justify further equity investment, needs to be able to deliver higher returns for shareholders as well. And that self-correcting mechanism is always quite a powerful driver of equity returns as well. So I think coming back to what we've delivered, so in South Africa, the last year, you can see there's one chart where we looked at South Africa, the JSE return versus the FTSE World Index, and then also the Dow Jones Islamic Market Index. What is striking there is that the JSE has actually outperformed, that's in dollar terms, both of those two markets, and then the Islamic Market Index also outperforming the FTSE World Index as well, which I think is testimony to the fact that the same set of positive variables that have driven South African returns at about 22% for last year also apply to the Sharia market, also apply to the Islamic market, and if investors invest accordingly, they actually will have superior returns compared to the broader FTSE World Index as well.
Now, equities in my day in investing, Abdulazeez, was obviously one of the more riskier sectors of the market to invest in. However, over the long term, it always shows profit at the end of the day. I mean, I can remember back in 2004, where the average return of an equity fund was around 15 to 20% per annum. It's been a little bit more volatile since then, yes. But still, over the long term period, it still gives you the ultimate value, as long as you don't have the heart attack of seeing your value drop in between here and there. Abdulazeez, the mining sector. I see on one of your slides that you say that the mining sector is in a sustained boom at the moment.
Yes.
Am I reading that correctly? Is it because it's become a safe haven, or is it just because mining is in demand at the moment? Minerals mining.
Yeah, I would say it's a sustained boom for the short term. I wouldn't call it sustainable for the long term. And one has to be selective in terms of the commodities as well. So I think most commodities that have real world applications like platinum, palladium, even iron ore as well, are enjoying the positive momentum because of the logistics and bottlenecks that we see in supply chains. So there's more demand chasing those metals because people can't, manufacturers, your car guys, your car manufacturers, they can't get access to the supply of those commodities. So they're willing to pay a lot more for those commodities. Now, that is not a sustainable sort of, environment, but selectively what is going to drive demand is effectively the underlying product demand. So on a select basis, if one looks at iron ore, for example, it's steel demand, it's demand for manufacturing, especially from the auto sector. But then supply and the supply response is also quite important. There's abundance of iron ore globally. The iron ore cost curve means that a lot of miners are making massive super profits at current iron ore prices well above $100. And similarly, I think you can go through these commodities. Oil market, a similar phenomenon. Break even for OPEC is sitting sub $25. So at $90, $92, the Brent oil price is, they're making substantial profits as well. And normally with commodities, they say what solves high prices is high prices. What that means is that, when prices go high, it stimulates supply responds, produces more, and prices come down because they generally flood the market or oversupply the market. Unfortunately, in this cycle, it's very difficult to oversupply the market because of the logistics challenges and the bottlenecks that we see globally. And that's why we say it is in a sustained period of boom. But at some point, these logistical issues will be worked out and worked away. And then it will be up to the underlying demand and supply for these commodities that will actually drive their share prices and drive the commodity prices as well.
Now, I mentioned earlier that equities is obviously one of the more riskier options at the moment, but currently there's a more riskier option. We've seen, and you predicted it in our last conversation, where I could pick up immediately that cryptocurrency was not one of your favorites, and neither is it one of mine either. But we've clearly seen the pressure on cryptocurrency at the moment, and we've seen major losses. And whether that sector of the market is going to recover, one only has to hope. But give us a little bit of synopsis of what's happening in cryptocurrency at the moment, because it's been in the news for the last month now, telling us exactly the losses that's been sustained in the commodity.
Yeah, I think this is probably the more controversial part of our chat, and I'm not going to make any friends here, so especially amongst the millennial crowd. But I'm not a believer in cryptocurrency. Look, I think there's two issues. There's one need to separate, blockchain and its technology, which I think is a fantastic technology, from the actual cryptocurrency. And the chart that we shared with you is one where we look at the price of Bitcoin and how volatile that is, and we say that actually this is not a currency because it doesn't behave like a currency. So Bitcoin is, and again, we can argue the Sharia merits of Bitcoin, but at its heart, for Bitcoin to be Sharia compliant, it can't be a currency actually. It needs to be treated like any other commodity. Otherwise, if it's a currency, you can't trade in currency. I can't buy and sell dollars because that is not a Sharia compliant activity. So that's already the first issue and my first major problem, because I'm never going to invest in Bitcoin as an asset, because how I was brought up and how I was trained was that for you to buy an asset, there needs to be economic value that you derive from it, either through cash flows, dividends that get paid, or the actual inherent value of that asset. I must confess, and I'll put up my hand, I don't know how to value Bitcoin. I don't know what metrics to use to value it. What I can see is what is driving the underlying perceived value of the Bitcoin share price. And it's twofold. Firstly, what has driven the creation of Bitcoin was, and the chart that we show in the slide is the Bitcoin price versus the Federal Reserve balance sheet. And the reason for that is that you can see that that balance sheet has actually expanded. It's sitting at about $8 trillion at the moment. And that's effectively the stimulus, the unconventional stimulus, or QE, that was administered to the US economy to stimulate the economy. And that was all in the wake of the 2008 financial crisis. So Bitcoin has its origins from the 2008 financial crisis, where I think Alan Greenspan was still the reserve chairman, and he decided on this whole QE process where they would use it's like using our South African Reserve Bank's balance sheet to buy corporate debt and to buy issuances from Eskom and Transnet. You're creating an artificial buyer, which then depresses the price, because clearly more buyers, less sellers means that prices come down. So, and in that way, they've been able to lower the cost of funding and lower the interest rates for all sorts of corporates and for the US government as well. So I think Bitcoin is trying to exploit that, but the transfer mechanism for that, I think, is faulty, in the sense that 99% of people that have bought Bitcoin in the last 2 years bought it because they thought the price was going to go higher. That is, and then there's a concept called greater fool theory. You think that you're buying something in the hope that you'll sell it to some other fool at a greater price. And if you analyze, by far the demographic that have bought Bitcoin is our millennial demographic. And again, what has driven that has been access to cheap money. So again, that balance sheet expansion in terms of the Federal Reserve that we've seen has been putting direct money into people's pockets, either through actual checks that have actually been posted by the US government to their citizens, and through indirect, much lower cost of funding, much lower cost of borrowing. So a lot of youngsters have basically borrowed money to buy Bitcoin. And the bulk, I saw a stat that the bulk of the investment in Bitcoin over the last 2 years has been at an average price north of $60,000, sorry. So Bitcoin peaked at just under $70,000, I think in November last year. It promptly more than halved. It went below $35,000. It has recovered somewhat currently. Again, that is much more driven by, some of the institutional investor activity. But I do think that from here, if we are in a scenario where the US Federal Reserve starts to withdraw stimulus, rising rates start going up in the US, those are particular headwinds for Bitcoin, because it relies on discretionary monies to be the incremental buyer of Bitcoin. And as a result, and because it's not a currency, I think that, we are likely to see significant gains from Bitcoin. And there's actually substantial downside risk to Bitcoin when, sanity prevails in that market as well.
Abdulazeez, that's a lot to think about, especially the millennials, who's been so famously invested in the cryptocurrency. Abdulazeez, from Kagiso Asset Management side, you guys have, I see the beard has gone a little bit black in between, which means that the stress has not been that bad over the last year. But from a performance perspective, how's Kagiso's funds doing at the moment? And is there any news that we should know about from Kagiso Asset Management side?
Yes, I think it's all good news for our investors. Last year was a particularly good year. Across our funds, all of our funds have outperformed their benchmarks and peers. Just to quote some numbers, our equity fund did about 37% for the calendar year. That's the Islamic Equity Fund. Our Islamic Balance Fund has done about 27% for the year. Bearing in mind that both funds have actually outperformed their peers and benchmarks by at least around 10% for the calendar year. And then even our income fund, our high yields fund, has done particularly well. It's delivered just under 11% for the calendar year. Bearing in mind that this fund tries to just outperform inflation, which is running at about sub 5% at the moment. So to have done more than double inflation, we think it's quite a credible performance. And as a result of that, we've been nominated for awards. Islamic Equity and Islamic Balance Fund was nominated for Raging Bull Awards. Unfortunately, we didn't win, but we always applaud the nomination nonetheless. And then later next month, we've been nominated for the Morningstar Award for all of our unit trusts. So across the board, both conventional and Sharia funds. That's basically the Fund Range Award. And we did win this award in 2020. We missed it out in 2021. But hopefully we can win it again now in this period as well.
I think, when one looks at the last while, took a real management team to be able to manage the finances or the money of clients in South Africa. I mean, a market that was exceptionally volatile, a market that was heavily under pressure, and many losses were sustained across the board. But yet, Kagiso, we have to commend Kagiso and you and your team for the good management and the I think it's more of an educated management, doing the research properly, managing the risk in the right way, that the performances have shown where it is at the moment. Abdulazeez, we always know that in any market condition there are opportunities, and obviously in your funds there's obviously opportunity for the medium to long-term investor. Still going forward, and that's proven in the numbers that we see. In conclusion, anything you'd like to pass on to your clients and future clients and the global South African community as it stands?
Yeah, I think in summary, we're quite optimistic and positive on markets. Just to give you a sense, I mean, the average company that we invest in Japan trades on a single-digit PE multiple, and it pays about a 3 to 3.5% dividend. Now, that is better than most companies in South Africa. I mean, a company like Panasonic, there is a large battery supply to Tesla, for example. We've got a company called Nishinbo, which also is the world's largest producer of brake pads and frictional materials for brake pads, also trading on single-digit PEs. These are world-class, and we know Japanese technology and the work ethic in Japan. So these are world-class companies that are trading on lower multiples than the average South African company and still paying dividends as well. I mean, by far our biggest holding is a company called Inpex, which managed to deliver the Ichthys LNG facility off the coast of Australia. It had a price tag of $30 billion. And this company managed to bring it online in time and in budget, while still paying dividends to their shareholders throughout that investment phase. And literally just before lockdown and just before COVID hit, in about November 2019, they opened the taps on the LNG plant, and clearly benefiting now from very high natural gas and oil prices as well. So, and again, I mean, they're actually reporting the results tomorrow. We see that the single-digit PE, substantial scope to pay massive dividends as well. So I'm quite excited about Japan. I'm quite excited about South African equities. Similarly, we've got companies from the likes of Telkom to Libstar, even Metair, which we invested in locally, that will benefit from both the reopening trade and the recovery, but also the longer-term drivers in terms of environmentally friendly vehicles on the road, and similar sort of long-term themes in our market as well.
Abdulazeez, thank you for your time and once again imparting your knowledge to our viewers and listeners. This has really been an eye-opener to what we can expect for 2022. It's also an eye-opener that we should be looking for opportunities going forward, and one of those opportunities is obviously the safer markets to invest in. And South Africa, as it stands, the way it looks like, is one of those emerging safer markets at the moment, as long as you get the proper advice before investing. Shukran once again, Abdulazeez, and we wish you and your team the best for the future in 2022, and we'll definitely speak to you in the next quarter of 2022.
Shukran, and thank you very much for the opportunity. We look forward to meeting up again in 3 months' time.
Indeed. This is the SA Diplomat's weekly roundup. I'm Abdu-Raof Hanslow, And you can find us on our website, www.sa-diplomat.com, for the viewing of this interview, as well as tune into the SAFA on-air World Radio for the global South Africans, where this interview is also going to be played live. We thank Abdulazeez Davids and Kagiso Asset Management for their contribution to SA Diplomat Abroad, as well as the weekly roundup. Without them, this would not be possible. So we hope that you've benefited from the knowledge that's been imparted to you, and we wish you well for the future. Until next time, goodbye.